$2,847. That is the amount wired every single month from a small apartment in Jersey City, New Jersey. A 52-year-old Pakistani man, lawful permanent resident since 2011, runs a late-night convenience store in Newark. 6 days a week, sometimes 7. For 8 years straight, he sent money home to his elderly father in Lahore and his sister's household in Faisalabad. Every month, same amount, same date, same Western Union location 2 blocks from his store. 8 years of consistency, 8 years of sacrifice, until February 2026, when everything stopped. Not by choice, because Wells Fargo placed an emergency freeze on his account. The reason stated on the notice: unusual transaction pattern, compliance review initiated. 72 hours after that freeze, 2 federal agents from Homeland Security investigations appeared at his store during the morning shift. They carried a folder thick enough to be mistaken for a legal brief. Inside were printed records of every international wire transfer he had made over 8 years, copies of his bank statements going back 4 years, and his last 3 federal tax returns. The agents had done the math before they arrived. Total amount transferred internationally over 8 years, $247,000. His reported annual income on his W-2, $41,200. The question they asked was simple and devastating. Where does the rest come from? He had a completely lawful explanation. He owns his store jointly with his older brother, who also draws income from the business. He receives a small but consistent rental payment from a tenant in a property his family purchased together in 2019. Every dollar of income was reported, every tax return was filed on time. His accountant had the records, his bank had the statements, everything was there in black and white, but the investigation had already started. The suspicious activity reports were already in the federal database. And because of a data sharing agreement between the IRS and Immigration and Customs Enforcement that went into effect in April 2025, the tax documents he had filed faithfully for years were the exact documents that drew federal attention to him in the first place. He was eventually cleared. It took 13 weeks and cost him $11,000 in attorney fees. During those 13 weeks, his business account remained frozen. He could not restock his shelves on credit. He could not meet his payroll obligations on time. 2 part-time employees had to find work elsewhere, and his 81-year-old father, who depended on that monthly transfer for insulin and household expenses, went without for 3 months straight. 3 months? For a man who had missed not a single payment in 8 years. That is the reality of how this system operates in 2026. It is not designed to catch only criminals. It catches careful, honest, hardworking people who simply did not know that the rules had been rewritten around them. He did not break a single law. He did not hide a single dollar. He filed every form on time and reported every source of income, and he still found himself sitting across from federal investigators trying to prove his own innocence. Because the framework changed quietly and without announcement, and nobody made sure the people most affected by those changes actually knew about them. This video is about making sure you know 5 things you must understand, 5 mistakes you must avoid, 5 steps that will keep you protected. By the time this ends, you will have a complete picture of how the United States government monitors every dollar that leaves this country and exactly what you need to do to ensure that your money, your family, and your future stay safe. Let us get into it. Start with the rule that everyone thinks they understand, but almost nobody actually does: the $10,000 reporting threshold. The Bank Secrecy Act, which has been federal law since 1970, requires every financial institution operating in the United States to submit a currency transaction report to the Financial Crimes Enforcement Network, FinCEN, which operates as a bureau within the United States Treasury Department. This report must be filed whenever a customer completes a cash transaction totaling $10,000 or more within a single business day. The category of transaction does not matter. Whether you are depositing money into your account, pulling cash out, converting currency, or wiring funds abroad, if the total crosses $10,000 in one day, a federal report is filed automatically. The institution does not have a choice. You do not receive a warning, it simply happens. The mistake people make is assuming they can stay under the radar by keeping every transaction just below that line. Send $9,800 instead of $10,000. Deposit $9,500 instead of $12,000. Split the amount across 2 visits the same week. This is not clever. This is a federal offense. It has a specific name: structuring. It is criminalized under Title 31 of the United States Code, Section 5324, which makes it illegal for any person to deliberately arrange transactions in a way designed to avoid triggering the reporting requirement. The law does not require prosecutors to prove that the money itself was dirty. The act of deliberately structuring transactions to stay below the threshold is the crime, regardless of where the money came from. The consequences are severe. A conviction for structuring carries a prison sentence of up to 5 years and financial penalties up to $250,000 for individuals. For businesses and corporations, those fines can reach $500,000. Federal courts have consistently upheld these penalties even in cases where defendants had no other criminal history and where every dollar involved was legitimately earned. A case that illustrates this clearly: a small business owner in suburban Texas made a series of cash deposits over several months. Each deposit was carefully kept below $10,000. He thought he was being cautious. His bank thought he was being suspicious. The bank filed reports. The IRS Criminal Investigation Division reviewed the pattern. He was charged with structuring, convicted, and sentenced to 2 years in federal prison. The business was legitimate. The money was clean. The crime was the pattern. Banks are not just passively watching for this, they are actively trained to detect it. And when a bank believes structuring may be occurring, even without a single transaction crossing the $10,000 mark, they are authorized and in many cases required to file a suspicious activity report known as a CTR. That CTR is transmitted directly to FinCEN and becomes part of a permanent federal record attached to your name and account. Now, here's the part of this story that most people who send money home have never heard, and it is the part that matters most in 2026. On November 28, 2025, FinCEN issued a formal alert to every money service business operating in the United States. That includes every Western Union franchise, every MoneyGram location, every licensed remittance agent, and wire transfer outlet in the country. The alert directed these businesses to file a CTR on any transaction of $2,000 or more if the agent has any reason to believe the funds are connected to income earned outside of legal employment or obtained through improper means. $2,000, not $10,000. $2,000. What that means in practice is that if you walk into any money transfer location in this country and attempt to send $2,000 or more, and that agent has any basis to question your income source, a federal report is generated on that transaction. The FinCEN alert specifies exactly what agents should look for: regular transfers that fall into predictable round number patterns, transfer amounts that do not seem consistent with the occupation the sender has described, multiple transfers going to different recipients in the same geographic area, customers who appear to be visiting multiple locations, identification documents that are incomplete or raise any questions. Take a moment and think about how many of those descriptions apply to people who are doing absolutely nothing wrong: a restaurant worker, a warehouse employee, a home health aide, someone who sends $1,800 or $2,200 home every month because their parents are aging and their siblings need support. To a trained agent watching for those FinCEN red flags, that person's behavior looks identical to behavior the system is designed to flag. The system cannot tell the difference between a caring son and a suspicious actor. It only reads patterns. And if your pattern fits the profile, a report gets filed. What makes this especially significant is where those reports go. Under the USA Patriot Act and a series of executive directives, SARs filed with FinCEN are accessible to more than 300 federal, state, and local agencies. That list includes the FBI, Homeland Security investigations, and Immigration and Customs Enforcement. A SAR filed at a wire transfer counter in Queens or Houston or Chicago does not stay local. It enters a national database that multiple enforcement agencies can access and act on. In April 2025, a formal agreement was signed between the United States Treasury and the Department of Homeland Security, establishing a direct data sharing pipeline between the Internal Revenue Service and ICE. Under the terms of this agreement, ICE is permitted to submit lists of names and identifying information to the IRS. The IRS then searches its taxpayer database and returns confirmed information, whether the individual has filed taxes, what income they reported, what employer information appears on their returns, and what address they used when filing. The scale of this program was made clear through documents that became public. In one submission, ICE sent 1.28 million names to the IRS. Of those, the IRS confirmed and returned detailed information on more than 47,000 individuals. A legal challenge brought by immigration advocacy organizations sought to block this data sharing. In May 2025, a federal district court denied that request, ruling that the shared information does not fall under the taxpayer privacy protections established in Section 61103 of the Internal Revenue Code. Then, in early 2026, it was reported that the IRS had gone further than the agreement authorized, sharing data on individuals who were not included in the original ICE submission. The consequence of this for ordinary immigrants is direct and serious. If you have filed your taxes, which the government encourages and in most cases requires, your tax return now serves as a potential identification and location tool. Your ITIN, your employer's name and address, the income figures you reported, the address you listed, all of it can be confirmed and handed to immigration enforcement. Filing correctly does not protect you from being identified. In some cases, filing correctly is precisely what makes you identifiable. On top of the surveillance and data sharing infrastructure, 2026 brought an entirely new financial burden for people sending money abroad. Legislation signed into law in 2025 introduced a 1% excise tax on international remittance transfers originating in the United States. The tax became effective on January 1, 2026. If you sent money abroad using cash at any licensed transfer service after that date, you have already been paying it, whether you knew about it or not. The exemption built into the law is critical to understand. If your transfer is funded directly from a U.S. bank account, through a U.S.-issued debit card, or charged to a U.S.-issued credit card, the 1% tax does not apply. The tax is triggered specifically by cash payments, money orders, and cashier's checks. In other words, if you have a bank account and use it to fund your transfer, you pay no tax. If you do not have a bank account and pay in cash, you pay the tax on every transaction. The math on this is worth understanding clearly. On a $500 monthly transfer paid in cash, the tax adds $5 per transaction. That is $60 per year and $600 over a decade. On a $2,000 monthly transfer paid in cash, the tax adds $20 per transaction. That is $240 per year and $2,400 over a decade. That money comes directly out of what you intended to send to your family. It is a tax on an act of financial support, applied to the people least likely to have alternatives to cash. The compounding effect makes it worse. A cash transfer at or above $2,000 triggers the new FinCEN CTR threshold. That same transfer is also subject to the 1% excise tax. So a single transaction simultaneously generates a federal report and incurs a tax penalty. Two consequences from one action affecting the same person in the same moment. For residents of border communities, the exposure is even greater. In March 2025, FinCEN issued a geographic targeting order applying specifically to money service businesses operating in designated areas near the U.S.-Mexico border. Under this order, those businesses are required to file transaction reports at thresholds significantly lower than the national standard. If you live in southern Texas, southern Arizona, southern New Mexico, or the border regions of Southern California, the reporting rules that apply to your wire transfer transactions are stricter than the rules that apply to someone doing the exact same thing in Chicago or Atlanta. Your zip code changes your legal exposure. Understanding how a routine transfer can become a federal investigation is important. When you send money, the money service business generates a SAR or CTR and submits it to FinCEN. FinCEN's automated systems analyze that filing against your prior transaction history. If the pattern raises flags, frequent transfers, amounts that do not match your declared income, multiple SARs filed over time, your profile is elevated within the system. ICE can submit your name to the IRS, which confirms your tax filing status, reported income, employer information, and address. If your international transfer volume significantly exceeds your reported income, that gap becomes the basis for a referral to Homeland Security investigations. From there, HSI can open a formal case, conduct physical surveillance, contact your employer, or obtain a subpoena for your complete financial records. That entire sequence can be set in motion by one cash transfer of $2,000. And once an investigation opens, the burden of disproving suspicion falls entirely on you. Legal representation, document gathering, missed work, frozen accounts, all of it begins before any charge is filed, before any finding of wrongdoing, before anyone has proven that you did anything at all. Here are the 5 steps that every person sending money internationally needs to take right now. First, open a U.S. bank account and use it to fund your transfers. This is the single most impactful thing you can do. Electronic transfers from a verified U.S. bank account are exempt from the 1% remittance tax and carry a substantially lower reporting risk than cash transactions. Many banks and credit unions accept ITINs or passports in place of Social Security numbers. Community development financial institutions and certain online banking platforms also offer accessible account options. If you do not have an account, getting one should be your immediate priority. Second, never break up transactions to avoid reporting thresholds. Do not send 3 separate transfers on the same day or across consecutive days to stay under a limit. Do not use different locations or different family members as senders to distribute the amount. Do not ask friends to send on your behalf. All of these behaviors constitute structuring under federal law, and they apply regardless of whether the money is legitimate. The pattern is the crime. Third, keep thorough documentation of every source of income. If you earn from a job, a business, rental property, freelance work, or a spouse's income, maintain organized records for each source. Pay stubs, tax returns, lease agreements, business registration documents, 1099 forms, all of it should be stored and accessible. If your total transfer volume ever comes into question, this documentation is what separates a cleared investigation from a prolonged legal ordeal. Fourth, file your tax returns accurately and consistently. Yes, the IRS-ICE data pipeline creates complexity around this, but failing to file creates its own serious consequences: civil penalties, interest accumulation, difficulty demonstrating lawful presence, and obstacles in immigration proceedings. The answer is not to avoid filing. The answer is to file correctly with the help of a tax professional who works specifically with immigrant clients and understands the intersection of tax compliance and immigration status. Fifth, if multiple income sources contribute to your household, make sure all of them are properly documented and reflected in your tax filings. If a spouse earns income, if you have a second job, if you receive rental income, none of that should be invisible. Investigators who see transfer volume that appears to exceed your reported income are not looking for nuance. They are looking at numbers. Make sure your numbers tell the complete and accurate story of your financial life. Here is the side-by-side comparison that makes the stakes concrete. A worker without a bank account sends $2,000 per month in cash at a local wire transfer outlet. Every transaction is above the FinCEN SAR threshold. Every transaction incurs the 1% excise tax. Over 12 months, that is $240 in tax, 12 federal reports filed under their name, and a pattern accumulating in a national database. Over 3 years, that pattern becomes very difficult to explain away if an investigation ever opens. A green card holder with a verified U.S. bank account sends $2,000 per month electronically. No remittance tax applies. The transaction carries a lower reporting risk because the identity and income source are verified through the account. Annual costs are limited to modest wire transfer fees. The financial record that builds over time is clean, transparent, and consistent. The gap between those two situations is not income. It is access. It is documentation. It is knowing which tools to use and why they matter. On the subject of informal transfer systems, arrangements that operate outside of licensed and regulated channels, the legal framework is unambiguous. Facilitating money transfers without a federal money service business license is a criminal offense under 18 U.S.C. 1960. The potential sentence is up to 5 years in federal prison. If those transfers are found to connect to any other violation, tax irregularities, immigration offenses, any other federal matter, the potential sentence rises sharply. The U.S. Treasury's 2026 National Money Laundering Risk Assessment specifically identifies these informal networks as elevated risk vehicles for illicit financial activity. This does not mean that everyone who has ever used an informal transfer has committed a prosecutable offense. It means that if your name is already appearing in FinCEN reports, if SARs have been filed on your transactions, if you have passed through the IRS-ICE data pipeline, then any additional involvement with unlicensed transfer systems dramatically increases your legal exposure. The formal financial system costs more and involves more scrutiny, but operating within it with proper documentation is a fundamentally safer position than operating outside it. Here is the complete picture of where things stand in 2026. The threshold that actually matters for most people sending money home is not $10,000. It is $2,000, the FinCEN SAR threshold that applies specifically to money service business transactions and was specifically designed with international remittances in mind. The IRS-ICE data sharing agreement is not a proposal or a pilot program. It is active, it has already produced results affecting tens of thousands of people, and federal courts have declined to block it. The 1% remittance tax is law. It took effect at the start of this year, and it specifically penalizes cash users who are disproportionately the people with the fewest alternatives. Geographic targeting orders have created zones of heightened financial surveillance along the southern border, and the chain of events that connects a routine money transfer to a federal investigation at your front door is not theoretical. It is documented. It is happening. None of this should stop you from taking care of your family. That is not the point. The point is that how you do it matters enormously right now, in ways it did not matter 5 years ago. Open a bank account, use electronic transfers, keep your records in order, file your taxes completely and honestly, work with professionals who understand both sides of your situation, and make sure the people around you, your neighbors, your coworkers, your community, have access to the same information you now have. If this video helped you understand something that you were not aware of before, please like it and subscribe to Senior Support USA. Every week, this channel covers these issues in full detail with verified sources so that you are never the last person to find out when something important changes. Leave a comment below. Tell me how you currently send money home. Tell me whether you have a U.S. bank account. Ask whatever questions you have. I go through the comments and I respond. Next week, the topic is what you need to know about your electronic devices before you travel through a U.S. airport. The CBP's updated electronic device search policy went into effect in late April 2026, and it has implications for every international traveler. Make sure you are subscribed before that one goes up. Stay informed, stay protected.